Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our IFRS Insurance webcast on the 22nd of November 2016. Today's webcast is titled IFRS 4 Phase 2 will be IFRS 17, effective from the 1st of January 2021. Many changes approved on the likely final meeting of the multi-year insurance contracts project. As it is our custom, we have structured the webcast around a 3 items agenda. First, I will give you the highlights of the ISB meeting on the 16th of November 2016, last Wednesday. Then we'll spend most of today's webcast by talking on the ISB staff analysis, the discussion the board had, and the tentative decisions they reached. And then we'll spend a few minutes at the end to discuss what are the next steps that will take us forward from here. The highlights are quite there are quite a lot of them, and I actually struggled to fit them all in one page. The first one I want to draw your attention is we have an effective date, as mentioned in the title, that has been now chosen to be the 1st of January 2021, on the assumption that IFRS 17, which is the official new name for IFRS 4 Phase 2, is published in the first half of 2017. There were quite a number of papers, 8 papers plus a cover note, 177 pages in total, so quite a lot of material to go through. These papers were developed primarily from the field testing work and the confidential review analysis that were conducted during the summer months of this year. In terms of the major decisions, the first one, perhaps the most groundbreaking news, is that the transition approach that IFRS 17 will require us to complete in order to adopt IFRS 17 for the first time is fundamentally simplified from prior decisions, with new choices available across previously mandated restatement methods. In particular, the fair value approach restatement can have a much wider application than before, and there's perhaps in that simplification is the component which has got the most far-reaching consequences. Also, the level of aggregation is being simplified. There are now going to be only a minimum of 2 groups per year per portfolio within the entity. The linkage with the portfolio is being clarified, and also previously approved criteria to make groups open-ended have now been removed. The board clearly has given us with one hand and has taken with the other. But hopefully you will agree with me at the end of my explanation that the net result is still a positive contribution to the quality and operational implementation requirements of the standard. There are also some positive outcomes on the clarification of how the VFA criteria will be applied and how mutualization will be considered in the decision of groups. So those are the major highlights. Many other things, but the main ones are highlighted on this page. So let's now begin the journey on a topic-by-topic basis so we can understand where the staff came from and how they reached the recommendations which were then voted by the ISB. The first topic I want to cover is the mandatory effective date of IFRS 17. The first point in the analysis of the staff is that IFRS 17 is as great as the complexity of implementing other standards recently issued. If you think about the leasing standard and you look at how many articles have already been written by all possible magazines and newspapers, clearly there is a lot of complexity on that standard too. The board staff concluded that, in their opinion, IFRS 17 is probably most comparable to the bank's application of IFRS 9 and the expected credit loss model. There is a need, of course, with such a complex standard to balance, on one side, the advantages and the benefits of granting a longer implementation period with the disadvantages of allowing an inferior accounting practice, such as the one that we have at the moment in many IFRS jurisdictions, to continue. Given the operational complexity, the staff concluded that will come from data gathering, system implications, a period of approximately 3 years still remains, in their view, the most appropriate. And so something between 3.5 and 4 years would be perhaps the maximum amount I would anticipate the board to approve, which still maintain a mandatory effective date that will allow a large number of insurance companies to meet the increased complexity of the financial reporting. At the same time, as a number of insurance solvency regulators are introducing new regulatory capital requirements, or when those regulatory capital requirements are not changing, but they are based on financial reporting, they may actually pick up higher liabilities than they used to under IFRS 4 Phase 1. All that is clearly a reality, business reality, and the extent of the period that the staff analyzed would be given for the implementation of IFRS 17 should also be sufficient to mitigate the possible effects on regulatory capital requirements. Those should not be considered beyond what in the staff should be a reasonable extent of time, because ultimately the standard is intended to provide transparency and comparability to investors, and is not been written to offer to the insurance solvency regulators to have a foundation effectively upon which to build a new risk-based capital. With that analysis, the recommendation, as already know from the highlights, was to make IFRS 17 compulsory for annual periods beginning on or after the 1st of January 2021, if the standard is actually published in the first half of 2017. If an entity wished to adopt IFRS 17 earlier, that will be possible, but it will come with a condition, and the condition is that the adoption of IFRS 17 will have to be done also at the same time as IFRS 9 and IFRS 15 are implemented at the same time. Now, just to remind you, IFRS 15 is mandatory with an effective date of the 1st of January 2018. IFRS 9 is equally mandatorily applicable on the 1st of January 2018. However, if you are an insurance entity that can be defined to have predominant insurance activities being carried out, then you have the option to defer the effective date of IFRS 9 up to the 1st of January 2021. It's a coincidence, but the deferral of the effective date of IFRS 9 for entities with a predominant insurance activity coincides with the mandatory effective date without early adoption of IFRS 17. So obviously, if you want to adopt early IFRS 17, you also need to adopt at the same time IFRS 9. I think that goes without saying. As far as IFRS 15 is concerned, it's really just for those who want to adopt IFRS 17 shortly after the publication. I don't believe there will be many companies that will opt for an early adoption, but if it does, then IFRS 9 and IFRS 15 will have to be adopted at the same time. The discussion on these recommendations was quite an interesting one, and that's because one of the board members was particularly strongly putting forward his view that there should be at least a 5-year period being given to preparers to adopt the requirements of IFRS 17. And that's particularly because smaller insurers and those in developing economies may face greater difficulties to adopt a standard with the complexity of IFRS 17. He considered that there would be actually only marginal benefits if the effective date was recommended by the staff was going to be adopted by the board. Several board members disagree with him, and particularly they felt that the new standard was such a significant improvement over current accounting that could be delayed any more than what the staff was recommending. They also noted that in their wisdom, some projects that have been given extensive periods to be implemented, they turn out to be done in a non-efficient way. That's an opinion, of course. They also noted that, and this is more a factual assessment, smaller companies tend to have fewer products, and that in itself is a mitigating factor against the complexity of adopting IFRS 17. And so approximately 3 years was considered to be sufficient, particularly on the grounds that that was the response that most respondents to the 2013 exposure draft already wrote to the IASB at the time. In addition, those board members observed that the transparency of the IASB process has really given already plenty of time for all preparers to appreciate what the requirements will be, given that it is true that there's going to be a few items that were still evolving in the course of 2016, but a lot of the requirements have been effectively stable for a number of years already. So with that debate put to rest, when the chairman called for the vote, that one board member still held his position and voted against the staff recommendation, but the other 10 board members present all voted in favor. So we had a majority of 10-1. Then I would like to take you through the transition requirement, which has been significantly simplified. The analysis of the staff started by an identification of the issues that were brought up during the field testing. This exercise, which was carried out between July and September this year, stimulated a number of items for analysis, which resulted in an extensive range of recommendations that were categorized around 6 issues, which you see listed down on the slide. The first issue was around the impracticability criteria for restatement purposes. The second issue was around the use of different sources of data for the modified or simplified restatement approach. The third issue was around the reference date for the VFA modified or simplified restatement approach. Then there was another issue, issue number 4, regarding the fair value approach and the size of the restated CSM under that approach. Issue 5 was around how to group contracts when the impracticability was in place, and therefore there was not a full restatement being carried out. And finally, the extent of the disclosures on transition processes and amounts. For each of these 6 issues, the staff conducted an analysis of the outcomes from the field testing and set out recommendations to respond to any concerns that were deemed to be valid to improve IFRS 17 transition approach. So let's have a look at what each of these issues generated in terms of recommendations and simplification. And allow me to introduce you to this diagram, which I intend to use to walk you through the various changes. So you'll see this diagram changing as I explain the various decisions that the IASB has reached on transition. This diagram is built on a timeline, which is the line at the bottom, that shows where we stood on Wednesday morning UK time when the IASB started to debate the various recommendations. So at that point, we had a key principle in place within the draft IFRS 17 as we knew it at the time, which imposed first and foremost a full restatement as far back as possible for all the contracts that will be in force on transition date. Now in this example, I've shown you what the maximum comparative periods would be within certain jurisdictions that require financial statements to be prepared with a current period and 2 comparative periods being presented in the financial statement. So if that is the case, and that's the worst case that we know of, then you will have 4 balance sheets and 3 income statements. And you can see the dates. So the effective date would be the 1st of January 2021. So that's the beginning of the current period, ending on the 31st of December 2012, if you are a calendar year end, as I've actually decided to be in this illustration. And then for that calendar year end entity, you will have 2 comparative periods. The first one starting on the 1st of January 2020, and the second one, the older one, starting on the 1st of January 2019. That is the beginning of the earliest period presented, which marks the transition date. So effective date, 1 January 2021, and transition date in this instance, 1st of January 2019. And then you can see balance sheet 1, 2, 3, and 4, marking the 4 end and closing points of the 3 periods and the 3 P&Ls. If you then stand on the 1st of January 2019, transition date, then you need to look at all of your in-force contracts which still have an unexpired coverage at that point in time. And then you start calculating what is the opening CSM by fully restating those contracts and going back in time up to the point when you realize that the full restatement using contemporary information to calculate best estimate, liability, risk adjustment, and CSM at the point of sale at the inception of the contract is no longer possible. So in this example, that point, which is the impracticability point for the full retrospective restatement approach, arises after the restatement of the year -7 from transition date. The standard as we knew it before last week would have then asked us to follow a hierarchical restatement approach, which would have taken us to do a simplified approach restatement, the orange area, again to the point where a second impracticability would have arisen, and at that point a third and final method would have been possible, the fair value approach. So the staff concluded that in terms of guidance for establishing what the impracticability is and when it happens, they would not recommend there should be any specific special guidance for IFRS 17. They feel that IFRS 17 presents the same impracticability concerns as any other standard, and so no further guidance will be added to demonstrate impracticability under IFRS 17. So that is effectively what they put in the recommendation. Same guidance as we have it in IAS 8 will be applicable for IFRS 17. So studying those requirements is clearly important to establish your ability to appreciate whether or not impracticability will exist in your companies. For insurance contracts for which a group cannot be identified retrospectively, and for groups for which the retrospective application is impracticable, then the staff recommended you would then be permitted to choose between those two methods. So rather than following a strict hierarchy, simplified or modified retrospective approach first and fair value approach next, the staff recommended that you have a choice. The moment you reach the end of the yellow area, then you can choose between the orange approach or the green approach. If you choose the green approach, then you can do all of the groups of contracts that exist for those portfolios for those years using the fair value approach. If you decide to use the modified retrospective approach, then you must take that approach up to the point where it becomes impracticable, and only at that point use the fair value approach. So you can either do it because you choose to follow the same approach as it was mandatory before, or you can abandon that formally mandated sequence and choose instead to fair value everything that is beyond the first impracticability point of your restatement activity. The board agreed with the principle of maximum use of full restatement and approved unanimously the introduction of this permission to choose between the simplified approach and the fair value approach. So that's the first big news, is that is now a choice between those two methods that have been developed already in the previous deliberations of the board for restating beyond the first impracticability point. So now our diagram has changed its color. So the orange area now is a shade between orange and green to mark the fact that for that area there is now a choice available. So some entities may choose to still use the orange approach, others may choose the green approach. So this is the new world. Beyond the yellow area, which is the same for everyone, you have to push it back as far as you can. Then you have the choice between orange and green or just green. Nevertheless, the board staff realized by reading the responses from the field testing questionnaire that the modified retrospective approach could be simplified further to eliminates certain complexity, certain complex requirements that were highlighted by the field testing participants. To do that, they reiterated in their analysis that the objective of the modified retrospective approach remains to approximate the full restatement. And so the use should only to the extent the entity does not have reasonable and supportable information to restate. So it is an indirect message to the importance of pushing the impracticability point for the full restatement as far back as possible in time. But in terms of making then the retrospective simplified approach simpler, less complex, the recommendations that the ISB staff put forward is revolving around three aspects. The first one, again, is to reiterate that whatever happens with the modified retrospective approach, its goal is to achieve the closest outcome to the retrospective application using full restatement, using reasonable and supportable information that the entity may possess. The second component of the recommendation is that the use of specified modifications should be permitted, and there is an appendix in the BOE paper that is approved. This will be using minimum modifications, all of which will be necessary to meet the objective of the modified retrospective approach set out in the first bullet. And the third component of the recommendation is that applying the modified retrospective approach should make maximum use of information that would have been used to apply a full retrospective approach, but need only use information available without undue cost or effort. So this effectively opens the fact that the modified retrospective approach or simplified retrospective approach can actually have more of a mixed source of information, and that is the real change compared to the modified approach that we knew it before last week's decision, where we effectively had a compulsory methodology calibrated on the so-called backcasting of actual past cash flows on top of the best estimate liability calculated on transition date. The board agreed with these additional modifications and approved unanimously that their use should be the minimum necessary to meet the objective of the modified retrospective approach. So although it is now a choice to use this approach, I believe that you will agree with me that this is now less complex than it was in the prior draft decision. The staff then moved into the other approach, the fair value approach, given that this is now going to be applicable more extensively. They wanted to make sure that further guidance was introduced in the standard, and in particular, they recommended that when the fair value approach is used, a number of assessments could be done either at the inception of the contract, which is the normal approach, as long as it is supported by evidence contemporary to the inception date of that contract, or the alternative, it could be done at transition date. So that is the beginning of the earliest period presented. In our illustration, it happens to be the 1st of January 2019. It's a 3-year financial statements. Those assessments are the eligibility for VFA accounting, how to group contracts that are going to be fair valued, and how to determine the effect of discretion for indirect participating contracts. In addition, the staff recommended that when the simplified approach for VFA is utilized, so that is the restatement of contracts accounted for under the VFA, for which the full restatement is not practicable. In that case, the restated CSM will be set at transition date rather than at the date of initial application, which in our example is the effective date, given that our illustrative entity is a calendar year entity. So that makes the restatement more practical from an implementation perspective, because it doesn't force the insurer to wait until the 1st of January 2021 to find out what is the value, the fair value of the underlying items, which is a key element in the VFA simplified restatement approach. All these recommendations, again, were approved by the board unanimously. So now we move into another important change. So here you can see that the staff concluded that grouping by periods may not always be possible. And so those blocks of policies that are effectively clearly and neatly identified in our triangle may not actually be known because the date in which the policy was sold have been lost somehow. In that situation, it is also impossible for the entity to set the CSM accretion rate because the CSM accretion rate for the non-par and indirect par contracts is locked in at inception. If you don't know what the inception date is, then you cannot make a reference to the market discount rates at that particular date. And so that could create some kind of single group across each of the different portfolios, combining contracts which were effectively sold at different points in time, but those points in time have now been lost and can no longer be retrieved without undue effort. So with that analysis in mind, the staff recommended that an entity should be permitted to keep contracts in the same group even if they were written in different years. So this is for grouping of contracts that are not fully restated. And as you can see, the yellow area remains identical as before. We haven't changed that part. This is only for the point beyond which we can say it's now impracticable to fully restate our opening CSM. The accretion rate for the CSM, which will apply to both the non-par contracts and the indirect par contracts, and for the OCI solution, only applicable in this instance to the non-par contracts, would be set based on market discount rates derived from market interest rates at transition date. Now this means that the differential between market discount rates that would have been known if we knew the inception of the contract and those at transition date is effectively ignored, given that the comparative historical rate is not available. But that means that effectively this set of new requirements will lead us to a CSM on transition date, which is implicitly reset by reference to the same market discount rate used to determine the transition date, the fulfillment cash flows, which is measured prospectively on the 1st of January 2019 in our example. So that creates effectively a situation that would normally, in my personal opinion, lead the entity to gravitate more towards the fair value approach in terms of choice of the restatement than a retrospective modified approach, given that the retrospective modified approach still will call for some data being available, and given that this scenario appears to be missing an important piece of data, effectively the inception date, I would anticipate that if such a situation arises, then the fair value is most likely the best restatement approach to be selected. If the entity is choosing to apply for certain portfolios the OCI, the recommendation is that the accumulated OCI balance should be set to 0. So in the same way as you are not impacting the retained earnings on transition date by effectively recalibrating everything by reference to a fair value approach less the best estimate liability plus risk adjustment, equally the OCI accumulated balance should be set to 0. And also the recommendation is to make it clear in the final guidance of the standard that the effect of past contracts no longer enforce at transition date on the transition CSM for contracts not fully restated must be assumed to be nil. So the board again carefully considered these set of recommendations, but eventually approved them unanimously. And I felt it was noteworthy to report to you that one board member commented that these recommendations were, in his opinion, an extraordinarily generous concession. Then the staff work on transition reform, we can call it, moved on to the final of the 6 issues, disclosures on amounts reported at transition. Here, the recommendation is that all the disclosures required by IFRS 17 that relate to the CSM, the insurance contract revenue, and insurance finance income or expense should be provided separately for those insurance contracts that existed at the beginning of the earliest period, the transition date, and for insurance contracts written after that date. So any contract written from the 1st of January 2019, in our example, should be having its disclosure for CSM, revenue, and insurance finance income and expenses separately from those that were at transition. Second part of the recommendation is that the disclosure should explain how the entity determined the measurement of insurance contracts at transition for all periods in which disclosure are provided for. And in that case, they will have to provide information about insurance contracts that existed at the beginning of the earliest period in order to help the users understand the nature and significance of the methods eventually chosen to carry out the restatement and what judgments have been applied in order to define what is the mix of approaches that entity by entity will be adopted. And so investors will be able to compare effective restatement strategies that company X may have adopted vis-a-vis the strategy adopted by company Y. Finally, there should be a disclosure of the reconciliation between the opening and closing balance of the cumulative amounts included in OCI for financial assets measured at fair value through OCI if they are assets backing those insurance contracts where the accumulated OCI was set to nil. So those that were effectively grouped all together into a single group because of the inability to know when they were actually incepted. And once again, as it was the case in most of the transition simplifications, the board approved unanimously the recommendation from the staff. So now we can have a look at how this whole model looks like and realize that actually even at that point there was still one piece that the ISB approved, and that was not in the paper for transition. It was separately reported. It was in the other SWIP issues paper 2G. And if you read that paper, you find that issue 17 deals with another transition matter. And so the key change here is now we have a green cross on the third comparative period, the oldest comparative period. And what the staff recommended is that similarly to what they did for IFRS 10, and IFRS 12, there should be a relief given from the requirement to present an additional comparative period with some disclosure around it. And therefore, going forward, we have effectively eliminated, in all instances, the requirement to restate. Now, you can do that on a voluntary basis, but if you don't, the standard will not require you to do so, other than to demand some disclosures around the circumstances that effectively have led you to conclude that your third comparative column should not be restated. And of course, the standard will also require you to label that particular column as a non-restated piece of financial information in the annual report for the year ending 31st December 2021. So that is the final change to the transition requirement in IFRS 17. As you can see, it has been significantly simplified. The next topic the ISB deliberated is the level of aggregation. And here the staff analysis reported back that the field testing participants highlighted the significant number of groups that the criteria approved in the previous sessions by the ISB would have produced. Numbers like hundreds of thousands of groups within the same multinational group were quoted in the staff papers, and therefore the proposal here was to analyze how a more proportionate approach to grouping would it be possible. And what came up from the analysis is that there would be, first of all, a clarification, and that is that the concept of portfolio remains integral in the definition of groups. And so groups are effectively a portion of the portfolio. The portfolio is still defined as a group of contracts or contracts that are sharing similar risks and are managed together as a single pool by the entity. The portfolio is an open-ended unit of account, and the guidance will make it clear that product group is a valid example for a portfolio. So whole-of-life contracts, annuity contracts, those would be examples in IFRS 17 of portfolios. Then within that portfolio, you will split the portfolio into annual groups. Each year, the staff would require at least 2 groups to be created. The first one is going to include all those contracts which are deemed to be so profitable that the possibility of becoming an onerous group of contracts is unlikely. And then the second group is all the other profitable contracts. And so in this example, you can see that our portfolio is then divided in the 2 groups that the entity created on year X, and then the same in year X plus 1 and X plus 2. The group is closed. As you can see, the June decision to make the group open-ended, subject to certain strict criteria, is now being removed, and each group is bound by a maximum of 12 months. You can do groups shorter than 12 months, but 12 months is the maximum limit for new business effectively to be grouped together. There is a possibility at any point in time for a third group to be added to the 2 minimum required every year per portfolio. And that is if in that particular year there are contracts which are loss-making, those contracts will have to be grouped separately from the profitable contracts, and will effectively constitute an onerous group, which is represented here in the year X plus 1 by the dark green rectangle. Now this will only include contracts where the net present value of cash flows adjusted for the risk adjustment is loss-making, and so no CSM will be present for the onerous group. The entire CSM will still be divided between the highly profitable group and the other profitable groups. Now, if we look at the recommendation given this analysis, you will see some of those same features now codified into principles and guidance. The first point is the portfolio should be retained as a definition, with further guidance that actually explains that contracts within each product line would be expected to have similar risks, and hence contracts from different product lines would not be expected to be in the same portfolio. So this is an important point as to the level of granularity portfolios should take in financial reporting. The second point is that onerous contracts should be identified based on available information at the inception and grouped separately from contracts that are not onerous at inception. Insurance contracts that are not onerous at inception would then be measured by dividing the portfolio at a minimum into a group of contracts that have no significant risk of becoming onerous and a group of other profitable contracts. The staff has committed in their recommendations, but they have not provided yet, to develop further guidance on how to assess the risk of contracts becoming onerous. The staff also recommended that only contracts issued within the same year should be included within the same group. So that's the maximum extent in terms of time boundary for a group, 12 months. And then the CSM for a group of contracts will be allocated over the current period and expected remaining coverage on the basis of a particular number, a dollar figure, which is going to be called the coverage unit. And the coverage unit is a number that reflects both the expected duration and the size of the contracts in the group. So effectively is a unit of profit release that the insurer would be using for that particular group. And so each group will have its own coverage unit affected by the expected remaining coverage duration and the size of the groups of the contracts in that particular group. Finally, the interest rate that is used for accretion of the time value of money on the CSM balance would be calculated using a weighted average, and that weighted average can be averaged out of a period of a maximum 12 months, so 1 year. The same length of time that is permitted as the maximum duration for gathering contracts together into one single group will also be the basis of effectively averaging all the market interest rates that applied over those 12 months to determine the discount rate which the entity will then use to accrete interest on top of the CSM balance. All these recommendations were approved unanimously, but I want to bring to your attention some additional points here. And in particular, in paper 2G, which is the one that contains the 21 recommendations, so-called the other sweep issue paper. In that paper, the staff recommends to add further guidance on how an entity should reflect mutualization on the level of aggregation. It may result that in contrast with mutualization being effectively open-ended as far as the unlocking adjustments are concerned. And you can read that in the paper about level of aggregation, paper 2C, in paragraphs 36 to 39. At this stage, in my personal opinion, there isn't sufficient clarity as to the outcome of that. The language appears to be ambiguous. On one side, the staff says the boundary of 12 months applies to all type of contracts with or without mutualization, but then they effectively say that if there is mutualization, then that separation of groups over the 12 months period doesn't matter as far as the unlocking adjustment is concerned, and effectively the unlocking adjustment is spread over all the groups that are bound by the mutualization mechanism. So there is sufficient basis perhaps to conclude that there is effectively an open-ended group for contract mutualization, and then there are closed-end groups when mutualization is not in place. But the language is not as unambiguous as I believe I'm putting it to you, and so I'll leave it to your judgment then to either agree with me or perhaps agree with the staff and conclude that the language is indeed sufficiently clear. As far as I'm concerned, we will seek further clarity on these key points. Let's move then on to the last two sweep issues. The first one I want to talk about is the variable fee approach criteria. And this one is an important one because a lot of field testing participants have raised the fact that the contractual term wording in the first criterion of the VFA criteria was not entirely clear as to its intent and application. The words in the first criterion say the contractual terms specify that the policyholder participates in a share of a clearly identified pool of underlying items, and the emphasis here on contractual terms is added. And that's what the ISB staff has put as issue 12 in this paper 2G, the paper with all the sweep issues, indicating that their view was that contractual terms should be interpreted with reference to the substantive obligations that are enforceable, which is one of the cornerstones of the entire measurement framework that is captured by the IFRS 17 requirements. The standard will, as a result of this recommendation, explain that enforceable obligations may come from contract, law, or regulation. And so contractual term has to be read in that context. That means, in other words, that you can either write it in the contract or not. And if you don't, you can still pass the first criterion if there is an enforceable obligation, a substantive enforceable obligation arising from law or regulations. The standard also will add further guidance to explain that a contractor can arise because of a constructive obligation. That means because of past practice, non-written activity that generates in another party a legitimate expectation, which must be enforceable, that some behavior will take place from the insurer. However, it will be also explaining that not all constructive obligations would give rise to contract, and there will be a cross-reference to both the contract as defined in IFRS 17 as well as the same definition in IFRS 15, revenue from contracts with customers. As noted earlier, all recommendations in paper 2G were approved unanimously, so I would say that there is a positive outcome also on the application of the VFA criteria. The other three issues I wanted to talk about are the experience variances accounting, which changed the decision the ISB reached in the last session on the project, which was last June. You may remember from our webcast that in June they decided that experience adjustments which had an impact on changes in future cash flows would have been taken out of P&L and instead would have been accounted for as an adjustment to the contractual service margin. Effectively, it was an additional component to the unlocking adjustment. Now, if you look at this picture on the slide, you can see the four boxes, and you see on the left-hand side the experience adjustments. Prior to the June decisions, all those experience adjustments would have always gone to P&L, and so they would have been colored in blue if blue was the color to indicate P&L treatment. On the right-hand side, instead, up to that point, we would have had all green boxes, all going through CSM. Now, in June, the two boxes that are surrounded by the dashed blue line were green. The board at the time decided that they would take out of P&L treatment some experience adjustments because they were effectively connected with changes in estimates of future cash flows. The paper, some of the field testing participants indicated that this guidance was not clear, and so the ISB staff recommended to reverse that, and now we are taking out of the CSM unlocking adjustment changes in estimates of future cash flows that are related to some experience adjustments. So now we have more blue boxes than green boxes. So we have effectively turned the top two rectangles in the shape from being green, June decision, to being blue, November decision. Now, clearly, this is making the unlocking adjustments a bit more complex because we don't have to analyze the experience adjustments through, which was the complexity of the June decision, but now we have to analyze the changes in future cash flows. And we hope that at least the standard will be written in such a clear way to indicate that changes in assumptions are the ones that are effectively always adjusting the CSM, and changes in future cash flows which are not changes in assumptions will be effectively the only ones taken out of the unlocking accounting system into P&L. One board member, interestingly, voted against this change, whilst the other 10 were in favor of the staff recommendation. The last of the sweep issues that I wanted to comment in the webcast is on the VFA hedge accounting model, where field testing participants highlighted the residual presence of accounting mismatches due to the fact that the rules published in the field testing questionnaire on the hedge accounting for VFA contracts left certain risks out of the hedge accounting coverage. That has now been fixed. The staff recommended that all financial risks reflected in the insurance contracts can be taken into account in the application of the VFA hedge accounting, and the board approved this change unanimously. Now, in terms of the next steps, as we come to the end of our webcast, the staff will now have quite a lot of work to do. As you can see, is a lot of changes to be made, particularly in Appendix C, which is the appendix on transition. Once they've done their job, they intend to publish to a strict number of private individuals a fatal flow draft. So that will be effectively the complete standard, which will be given to probably something like 200 people in the world, with a number of weeks available for them to comment back only if they identify fatal flow issues in this draft, which means you can no longer argue as to whether you disagree with the decision of the board. You can only comment if those decisions have not been written down in a way that actually flow logically from front page to the last page of the standard. Once that fatal flow review is completed, the final text will be prepared and then given to the publishers for release to the public as a final published IFRS in the first half of 2017. In fact, the technical plan of the ISB indicates that March 2017 is the expected publication date. One area that remains undecided at this stage is whether or not the ISB will be setting up some kind of transition resource group for IFRS 17. They've been seeking views already in the public discussion of a number of their advisory councils. And so we'll see whether the merit of creating one group to work effectively after publication on how this transition to the new IFRS should be conducted will be created or not. And that completes today's webcast. I would like now to offer the last few minutes that we have in the slot for any questions, and in doing that, to ask Nikki, please, to close the record.